Hello again. This is Brandon Davis with Davis CPA Group, and I want to talk a little bit more about some year-end tax strategies. I had a little bit of video that I put up about just deferring and moving income and expenses. I want to talk a little bit more about investments, particularly capital gains, capital losses, things of that nature that happen around buying and selling stocks. One of the things that comes up pretty regularly is what to do at the end of the year if you're sitting on a substantial amount of capital gains potentially. One thing you can look at doing is what's called loss harvesting. Basically, what you would do is sell any positions that you might have at a loss to then generate a capital loss to offset capital gains. One thing you can do is you can offset all of your capital gains, short term or long term, with short term or long term capital losses. Now, if you generate losses in excess of your gains, you do get to deduct up to $3,000 against other sources of income. Now, say you have a situation where you sell a stock at a loss and it's more than $3,000, you don't lose that loss. That loss actually gets carried forward into future years until either offsets capital gains or you utilize that $3,000 per year limitation. Now, one thing too to consider is if you have business assets, let's say you've got something, you've sold your business or you've sold an asset for more than you paid for it originally. There'll be some depreciation recapture rules, which I'll deal with that in a separate video. But if you have any gains from business assets that are above your original cost basis, those too would be considered capital gains. And so what you could do is you could utilize capital losses to offset those gains. One word of caution on loss harvesting is if at the end of the year, let's say December 30th, you have some stocks that are at a loss to offset some gains and or even capital gain distributions or qualified dividends, which are also considered long-term capital gain type stuff. Whenever you look at harvesting those losses, be careful though, if you re-enter that position before the 31st day, you may be subject to what's called the wash sale rules. I've seen this happen before with a client of mine that wanted to harvest some losses in a tax year, and then when they came around to do the tax return and they got their 1099, the stock back on the 30th day versus the 31st day. And so that can basically make it so that you cannot use that loss. Now, what happens though is you don't get totally hurt on the situation because it would increase the basis of that stock that was repurchased. So you would get that basis, if you will, or that benefit upon the liquidation of that loss or that stock eventually. So one thing just to consider and just to be cognizant of is capital gain planning is a big thing to think about year end. Another strategy around capital gain planning is charitable contributions. If you were to itemize your deductions, basically be over the standard deduction, one way to do that is giving charitably. And if you give appreciated stock as a charitable contribution, and then you avoid picking up that gain, but you do get to take the fair market value of that stock as a charitable contribution. So it's another way to, maybe eliminate some gain exposure and benefit whatever nonprofit or charity that you might want to. So again, just another quick video, nothing really long and intense here about capital gains, capital losses around the year-end planning time frame that we're in here. Just want to give something out for everyone to kind of think about as again they're kind of going through their planning checklist. Again, this is Brandon Davis with Davis CPA Group. I love it if you'd subscribe to my channel. Again, a lot more content's going to come out. We're going to go into some deeper dives on some subjects that I get asked about often, and just kind of happy to be back here putting out some content, and hope everybody has a happy Thanksgiving.